Over the past year, Qualcomm is up by 15.5%, while Intel is down by almost 60% and AMD is down by 12.90%. Now, what you have to understand is that even though AMD and Intel fell a lot in price over the past year, that doesn't necessarily mean that they are undervalued. When we compare the three companies' PE ratios, we can see that actually Qualcomm's has been sitting the lowest, moving between 17 and 20 over the past year. AMD's PE ratio did fall a lot from its all-time high, but it is still sitting very high, sitting at 114, and Intel's PE ratio is currently negative as they have negative earnings. And so what this means is that from these three companies, Qualcomm is the only one considered fairly or even undervalued, but that doesn't mean that they have the biggest potential. So jumping to our stock valuation spreadsheets, let's first have a look at Qualcomm. And right away we can see that they have an above sector average dividend yield sitting at 2.12% with a dividend payout of $3.40 and a nice low trailing free cash flow payout ratio of only 35%, which means that after paying out their dividends, they can still direct a lot of their free cash flow into innovation, share buybacks, paying down debt, and increasing that dividend. Now, when we jump to the 9-pillar analysis, we can see that the company gets a rating of 9 out of 9. Now, we already know that their 5-year PE ratio is sitting nice and low at 15.13, but now we can also see that their price to free cash flow is also sitting low at 15.92. Now, what I like about the company is their high growth in profits. We can see that their revenue has been growing at 12.83% yearly over the past 5 years. Their free cash flow has been increasing very well as well, growing at a rate of 33% yearly, and their net income has been increasing at a rate of 28.29% yearly. Now, what I like about the company is that their free cash flow is higher and is growing faster than their net income. And the reason why I like that is because the free cash flow is essentially used for everything, as I mentioned before, while the net income is just a measuring metric. Now, jumping back to the 9-pillar analysis, we can also see that Qualcomm has been decreasing their shares outstanding over the past 5 years, which is nice. Their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.74, so they do generate enough free cash flow to cover all their long-term liabilities within a very decent time of about 4 years, and their 5-year profit margin is sitting at 57.59, which is above sector average. Now, let's also have a look at their consecutive dividend growth, which has been sitting at 5.42% over the past 5 years. And zooming in, we can see that that is actually above the average stock year-over-year dividend growth. And with their 5-year free cash flow payout ratio being so low, I do believe that Qualcomm will keep raising their dividends a lot into the future, making them an ideal company for that dividend snowball effect. Now, if you enjoy these spreadsheets and find them helpful, you can always download them in the link in the description. So now that we have gone through the 9-pillar analysis, let's quickly calculate Qualcomm's intrinsic value. So first, jumping to the Graham's formula revised, we will get an intrinsic value of $165. For the discounted cash flow model, we will get an intrinsic value of $277. For the multiples valuation when comparing Qualcomm to 3 of its competitors, we will get an intrinsic value of $224. And for the dividend discount model, we will get an intrinsic value of $182.46. And finally, when we average out these 4 valuation models, we get an ultimate intrinsic value of $220.45, which is 32.35% higher than the current trading price. And so it is quite obvious that Qualcomm is undervalued compared to the earnings they generate, compared to the free cash flow they generate, compared to their peers, and compared to their dividends and dividend growth. And based on the 9-pillar analysis, I really think that Qualcomm is a great investment into the future. And thanks to its high dividend and high consecutive dividend growth, it is a great investment for dividend investors particularly. So now that we have covered Qualcomm, let's move to analyzing the second company of the video, and that is Intel. So plugging in Intel's ticker, we will wait for the metrics to show up. And Intel has actually been in a very bad state over the past year. Over the past 5 years, actually, they have been run over by competition, and that has forced them to completely cut their dividend. They have been paying out a dividend since 1995, and by the end of 2024, they have cut it completely. Now, I will explain why I'm in love with the fact that they have cut their dividend. First of all, they can direct more of their free cash flow into innovation, which is exactly what they need to catch up with competition. If we move to the 9-pillar analysis and direct our attention to the long-term liabilities over the 5-year free cash flow, we can see that it is currently sitting in the negative. And when we zoom in to pillar 9, we can see that Intel is sitting on $53.5 billion in long-term liabilities. And as they are currently generating negative free cash flow, cutting their dividends saved them a lot of that free cash flow, which they were generating by going more into debt. So now that they have cut their dividend, they can focus on innovation and on paying down the debt they have collected over the past 5 years. Now directing our attention to the growth of the company, we can see that Intel has negative growth in revenue over the past 5 years, negative growth in free cash flow, and negative growth in net income. And if we zoom in onto these three pillars, we can see that indeed the revenue fell a lot over the past 5 years. The net income fell from 21 billion in 2020 to 1.7 billion in 2024. And as I already said, the free cash flow was negative in 2023 and in 2024. So Intel isn't really showing great growth. Now, one thing I do want to point out looking at their price to free cash flow over the past 5 years is that they have been recovering. If we zoom into pillar 2, that is the price to free cash flow over the past 5 years, we can see that in 2023 it was sitting at negative 14.59, in 24 it was sitting at negative 10.66, and currently it is sitting at negative 5.88. So over the past 3 years, Intel has been moving their free cash flow back into the positive. Now, what I also want to point out is Intel's earnings estimates. What you have to understand is that Intel has been going through a very tough time over the past few years. Intel is actually expected to hit the lowest earnings per share at the start of 2025. And by the end of 2025, the EPS is expected to be sitting at $0.98 and keep rising into the future. And that is actually the same case with the revenue, which is expected to rise by 6% in 2025, 7.4% in 2026, and 4.18% in 2027, with a potential rise of 14.40% in 2028. So overall, it seems like Intel is on a great recovery path, and with a strong brand name, I do believe that the internal management can turn things around. But now let's calculate the company's intrinsic value. So first, jumping to the Grams formula revised, we will plug in the 5-year earnings growth estimate at 8% yearly and calculate an intrinsic value of $40.50, which is 51% higher than the current trading price. For the second valuation model, we will plug in a calculated growth rate of 7.7% into the future. I plugged in an initial growth number of 9 billion, which is the free cash flow from 2024, and plugging in a discount rate at 12%, which is the minimum rate of return I would like from an investment into Intel, as it would be considered a riskier investment. We will get an intrinsic value of $29.42. For the third valuation model, we will compare Intel to two of its competitors. Now, as currently Intel has negative earnings per share, I plugged in the 5-year average earnings per share of Intel, and when I multiply that by the average PE of its competitors, we get an intrinsic value of $55.91. And finally, we will skip the dividend discount model, as Intel did cut their dividends, and arrive straight to the ultimate valuation, when we average out the three valuation models, we get an intrinsic value of $41.94, which is more than 100% higher than the current trading price. Now, if I was to remove the multiples valuation, as the earnings per share plugged in are the 5-year average, we would still get an intrinsic value that is 75% higher than the current trading price, sitting at $34.95. Overall, I do believe that Intel will manage to turn things around, but it is certainly a more riskier investment than Qualcomm. They currently do have a lot of debt and a lot of competition. But of course, with more risk comes more potential return. But now let's jump to analyzing the third company of this video, and that is AMD. So plugging in AMD sticker, we can see that they currently do not pay out any dividends whatsoever. We can also see that their beta is sitting at 1.66, meaning that they are 66% more volatile than the S&P 500. Now, jumping straight to the 9-pillar analysis, we can see that AMD gets a rating of 5 out of 9 with 3 pillars in the red. We can see that over the past 5 years, AMD has been trading very expensive compared to the earnings they generate and compared to the free cash flow they generate as well. If we zoom into pillar 1, we can see that from 2024, the P ratio did drop to about 108, but that is mainly because of the stock price drop, and that is the same case with the price to free cash flow. Now, what is interesting is that AMD is actually taking advantage of trading expensive by increasing their shares outstanding at a very aggressive rate of 8.29% yearly. If we zoom into pillar 7, we can see that they have increased their shares from 1.1 billion in 2020 to 1.6 billion in 2024. And by doing this, they are generating a lot of free cash flow. Now, one thing that AMD and Qualcomm have in common is their very high growth. We can see that AMD has been growing their revenue at a rate of 32% yearly over the past 5 years on average. Their free cash flow has been increasing at a very high rate as well, and their net income has been increasing at an even higher rate. Now, if we zoom in onto these pillars, we can see that the revenue has actually been quite stagnant from 2023 to 2024. Now, when we look at the net income, that has actually dropped from 3.1 billion in 2022 to only 1.3 billion in 2023, and then dropped again to 854 million in 2024. And that is the same case with the free cash flow actually, which dropped from 3.1 billion in 2023 to 1.1 billion in 2024. So not only does Qualcomm have better profits growth, but they are also trading cheaper compared to their earnings and compared to their free cash flow. Now, one thing a lot of investors, including me, love about AMD is their increasing and high 5-year profit margin. Their profit margin is currently sitting at 47.34, but if we zoom in onto pillar 1, we can see that it has increased from 42% in 2020 to 50% in 2024, and currently it is sitting at 52.12%, higher than the 5-year average. And finally, looking to the 9th pillar, the long-term liabilities over the 5-year free cash flow negative dividends, we can see that AMD doesn't have a lot of debt, and actually with the free cash flow they currently generate, they can pay off all their long-term liabilities in about 4 years. So now that we have gone through the 9-pillar analysis, let's calculate AMD's intrinsic value. So again, as always, first jumping to the Graham's formula, plugging in the 5-year earnings growth estimate at 30%, which is a very high estimate, we will still get an intrinsic value that is lower than the current trading price, sitting at $87.13. Now moving to the second valuation model, the discounted cash flow model, we will plug in a future growth rate of 9.3% and with a discount rate of 9.6% get an intrinsic value of $52.33, again much lower than the current trading price. For the third valuation model, we will compare AMD to 3 of its competitors and get an intrinsic value of $83.37, but that is mainly because of Broadcom's extremely high PE ratio. If we remove Broadcom, actually the intrinsic value would be sitting at only $26. But as Broadcom is one of AMD's competitors, let's leave it in. And finally, we will skip the dividend discount model and arrive straight to the ultimate valuation, where when we average out the 3 valuation models, we get an intrinsic value of $74.34, which is almost 40% lower than the current trading price. And with a margin of safety of 20%, we would get an acceptable buy price at $59.47. So after comparing these 3 companies, I would personally pick Qualcomm as a stock to invest in, with high dividend growth and high profits growth with an undervalued rating. Of course, Intel, in my opinion, has even more potential than Qualcomm, trading very undervalued, but that is if they manage to start growing their profits as expected. Otherwise, with their high debt, they are most vulnerable to bankruptcy out of these 3 companies. And finally, regarding advanced micro devices, they are extremely overvalued and have falling net income and free cash flow over the past 2 years. So I don't see a point adding them to your portfolio over Qualcomm unless you believe that they will for some reason skyrocket like Nvidia. And with that, I hope that you enjoyed the video. Let me know down in the comments what you think of these 3 companies and make sure to leave a like and subscribe as it really helps me out.